What could lead to a panic at the financial markets?
What should one do if there is a recession?
Some say that prices are rising and some that they are falling. Who should I believe?
What to do, buy or sell?
Why do some investors earn more and others earn less?
Hello, my name is Michael Bazilinsky and I am a financial advisor. Today, we will talk about the human factor and how investors react to unexpected events at financial markets.
Why do some investors earn more and others earn less?
There are many different reasons why. Most important is good market, so-called bull market, and correct selection of investments. It is much easier to make money when stocks go up. The real challenge is to perform reasonably well when the market is neutral or negative, so-called bear market. My approach is to recommend income-paying investments to provide a decent rate of return as income under any circumstances. And if we could get something, let's say 10% from price appreciation, it makes quite reasonable rate of return. So the timing is important. Also, very important is decision-making process. There are some investors that tend to overanalyze, waiting for a perfect entry point to buy investments, or they would try to get as high price to sell as possible. Most of the time, it leads to lost opportunity and losses. When it comes to panic, and I've experienced few instances with it during October '87 market crash and terrorist attack on the World Trade Center in New York on September 11, 2001, just to name a few. What happens after is precipitous market drop. What I have done was to contact all my clients and tell them not to do anything, because whatever decisions you make in a panic will be wrong. And of course, after a while, their markets recovered and everything was back to normal.
What should an investor do if prices for stocks suddenly start to fall?
It is always unpleasant. What I try to do is to explain and remind my clients why we have bought these investments in the first place. If the fundamentals are good, the prices will turn around and come back, and even go higher. But sometimes there are adverse circumstances, when the fundamentals and/or market conditions change, and sometimes it is necessary to sell with a small loss to avoid bigger losses.
How does the human factor affect the market?
As we've discussed before, what moves the market, if we oversimplify it, is greed and fear. When times are good, greed takes over and investors don't want to sell, expecting even higher prices. The opposite is true when the market is falling and investors want to sell everything, regardless of the price. My job is to point out why we got into these investments and recommend the sale when we reach our target on good markets and hold on to our investment during market decline.
What should an investor do in the case of sudden chaos or panic in the market?
As I've stated several times, any decision made in a panic would be wrong. So I do my best to try to have my clients hold on to their investments during crisis. But sometimes fear takes over and they decide to sell regardless of my advice. I can easily understand their action. It is their money and they make their own decisions.
How objective is information about the gains and losses of market participants?
Most people don't like talking about their failures. So all you hear how much money they've made, usually very quickly, on this particular stock, and how timely was their selling before precipitous market drop. According to these people, nobody lost money in 1987 market crash, since they sold just before, or they sold their .com and internet stocks before 99-2000 collapse. It should be taken with a grain of salt. I hope that this information is helpful to you. I'm always glad to discuss all your questions over the phone and in person. All the best.